In the years following World War II, Wall Street entered a period of profound structural transformation that fundamentally reshaped the American financial system and permanently redefined the relationship between capital markets, corporations, and everyday economic life. As the United States emerged from the conflict with unmatched industrial capacity, political stability, and global financial influence, establishing a position that no other nation could immediately rival. During the war, American factories operated at extraordinary levels of production, manufacturing aircraft, ships, vehicles, steel, machinery, chemicals, and other essential wartime supplies at a scale unmatched by any other nation. And when hostilities ended, this productive capacity was redirected toward civilian markets rather than dismantled or destroyed, allowing a rapid and remarkably smooth transition from wartime to peacetime economic growth. The American workforce, having gained experience and skills in wartime production, was prepared to meet the rising demand for consumer goods, housing, automobiles, appliances, and other household necessities. While American households themselves entered the post-war era with historically high levels of savings due to rationing, wage controls, and limited availability of consumer products during the conflict, creating significant pent-up demand that fueled economic expansion across multiple industries and geographic regions. Federal policy reinforced this momentum, most notably through the GI Bill, which expanded access to education, vocational training, and homeownership for millions of returning veterans, stimulating construction, banking, mortgage lending, and long-term consumer credit markets, while also encouraging the growth of suburban areas across the United States, contributing to new patterns of urban development and residential expansion. Infrastructure investment, industrial expansion, and demographic growth combined to accelerate demand for capital, prompting corporations to increasingly turn to Wall Street to finance growth, invest in new technologies, and expand operations across transportation, energy, communications, and emerging industries, all of which required long-term funding that public equity and debt markets were uniquely positioned to provide. The New York Stock Exchange experienced consistent growth in trading volume throughout the late 1940s and 1950s as publicly traded companies issued shares to support corporate expansion, while investors began participating on a broader scale, largely through institutional investors such as pension funds, insurance companies, and mutual funds, which became dominant forces in financial markets as employer-sponsored retirement plans and pooled investment vehicles expanded the reach of capital markets to millions of Americans who previously had little or no direct exposure to Wall Street. This shift from individual speculative trading toward institutional, professionally managed investment fundamentally altered the behavior of the market, increasing the emphasis on long-term planning, corporate governance, risk management, portfolio diversification, and regulatory compliance, while simultaneously reducing volatility and creating a more stable investment environment. Compared with earlier decades when speculation and individual trading dominated market activity, regulatory frameworks established during the New Deal era, including the Securities Act of 1933 and the Securities Exchange Act of 1934, provided the foundation for investor confidence during this rapid expansion. As the Securities and Exchange Commission enforced disclosure requirements, accounting standards, and trading regulations that promoted transparency, fairness, and accountability across all levels of financial activity, ensuring that the post-war boom was grounded in principles of trust and institutional stability rather than unregulated speculation. While the post-war boom brought unprecedented growth, it also revealed structural limitations within Wall Street's existing infrastructure as increasing transaction volumes, more complex corporate financing arrangements, and the proliferation of new financial instruments strained a system that still relied heavily on manual record-keeping, human intermediaries, and open outcry trading floors. In response, financial institutions implemented gradual but significant operational reforms during the 1950s, including improved clearing and settlement procedures, standardized reporting, the development of centralized data management systems, and the early adoption of electronic data processing technologies, all of which increased efficiency, reduced errors, and allowed the financial industry to handle more sophisticated investment products and higher volumes of trading, while maintaining human oversight and decision-making. These operational improvements represented the beginning of a technological transformation that would continue to define modern financial markets for decades, while also signaling the evolution of Wall Street from a purely domestic financial hub into a central player in global finance. Wall Street's influence expanded internationally during this period, as American capital played a central role in global reconstruction efforts, particularly through the Marshall Plan, which supported the rebuilding of European economies, strengthened allied nations, and reinforced the U.S. dollar's position as the dominant global reserve currency, establishing New York City as a key financial hub capable of attracting international investment and facilitating cross-border trade. Foreign governments, multinational corporations, and international financial institutions increasingly relied on American markets to access capital, further integrating Wall Street into the global economic system and establishing investment patterns, regulatory standards, and financial practices that continue to influence global markets today. Despite ongoing challenges, including inflationary pressures, labor disputes, geopolitical tensions associated with the early Cold War, and occasional market fluctuations, the post-war financial system demonstrated resilience, supported by strong corporate earnings, expanding consumer markets, increasing productivity, and widespread confidence in the sustainability of economic growth. People's views on Wall Street have changed a lot, as stock ownership became increasingly associated with long-term security, retirement planning, and national economic participation, largely due to the expansion of pension funds, mutual funds, and diversified investment strategies that spread financial risk across broad segments of the population. By the late 1950s, Wall Street was no longer perceived solely as a domain for wealthy elites or professional traders, but as an institutional pillar intertwined with middle-class prosperity, national economic stability, and long-term financial planning. Corporate governance practices adapted accordingly, with greater emphasis placed on transparency, standardized financial reporting, shareholder communication, strategic long-term decision-making, and risk management, reinforcing the stock market's role as a mechanism for sustainable growth rather than short-term profit-seeking speculation. These changes influenced not only corporate finance, but also the broader perception of economic policy, embedding financial markets into discussions of public planning, infrastructure investment, and social stability, while fostering the notion that a healthy Wall Street contributed directly to national prosperity. The structural foundations laid during the post-war boom shaped every subsequent phase of market development, from technological innovation in trading systems and the emergence of electronic trading to the expansion of global capital flows, the increasing complexity of financial instruments, and the evolution of institutional investment strategies. Modern characteristics of Wall Street, including the dominance of institutional investors, regulated transparency, diversified investment portfolios, technological sophistication, and the integration of financial markets into the daily lives of ordinary Americans, can all be traced directly to the transformations that occurred during this period. The post-war boom was not merely a temporary phase triggered by historical circumstance, but represented a lasting redefinition of how capital is raised, allocated, managed, and deployed within a modern economy. By linking corporate growth to public participation in investment, embedding financial institutions within regulatory and economic frameworks, and establishing operational and technological standards, the post-war era created enduring systems that continue to shape the financial landscape, facilitate the flow of resources, support industrial and technological innovation, and define the role of Wall Street in both domestic prosperity and global economic influence, ultimately creating a foundation for the modern American financial system that continues to operate and adapt to this day, connecting savings, investment, and long-term economic growth for generations.